Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Broadcom is trading lower in the pre-market after the company delivered a disappointing forecast. The company's outlook for AI semiconductor revenue was less than what analysts had been predicting. In its latest quarter, Broadcom beat on adjusted profit and revenue was in line with estimates. TransAlta is buying 2 gas-fired power plants in Colorado. The $1 billion purchase from Blackstone strengthens the Calgary-based company's foothold in the western U.S. TransAlta says the deal will immediately add to free cash flow. And Canaccord Genuity Group posted higher than expected fourth quarter revenue. This marks an increase of 33% over the same period last year. Adjusted earnings per share beat analyst estimates. The company says capital markets growth was led by higher investment banking, while wealth management continued to scale. And we're taking a look at, we'll start with the TSX today. This is where it ended yesterday, actually. It was down a couple hundred points. We'll continue to watch that for you today. Also watching U.S. futures. Here's they are down, most of them at least. The NASDAQ in particular down more than a full percentage point in pre-market trading. Broadcom earnings triggering concern that the rally in tech shares has maybe gone too far. And we'll continue to talk about that in particular throughout the morning, including right now. And as we just mentioned, shares of Broadcom are plunging in the pre-market today after the company posted its outlook for AI semiconductor revenue that missed expectations. The declines are spreading to other areas of the market as well, as analysts worry the rally in tech stocks may have gone too far. Joining us now is Hans Albrecht, equity fund manager at Option Pit, to break this all down. Good morning. Great to have you join us.
Good morning, Lindsay. Thanks for having me.
So one of the big news makers today is Broadcom stock, which is plunging in the pre-market. What do you think is behind this kind of sharp drop for this company?
Well, I think part of it is going to be the setup was sort of priced for perfection, right? The stock was a $300 stock. We ran up to about $480. And the guidance wasn't quite raised the bar enough for people. And so they didn't really touch the revenue target for 2027. So maybe a little bit disappointing there, given the run up in the stock. We have seen many stocks continue their rallies into good prints. This is not one of them. And I think part of that is that the semiconductor trade has been one of the strongest trades we've seen, in the last decade. It's been sort of relentlessly up, and I think we're seeing some interesting things. I watch the option space, right? So there's sort of when people get excited to the upside, we call that FOMO, that fear of missing out. We see that play out in upside call skew, and that means people are really moving aggressively into those upside calls to participate in that upside. And we've seen that to an extreme lately. So I think there are some signs out there that things have gotten a little bit overdone in the short term. Of course, it's all based on the thing that I keep talking about, which is infinite compute demand. This is early innings for AI, but we know that infinite compute demand doesn't mean infinite rises in stocks. And I think we're seeing that sort of unwind just a little bit here.
Right, because going back to Broadcom just quickly, like you were talking about, a revenue miss for 2027. It was the forecast for AI chip revenue, I believe, that was the miss here. Correct me if I'm wrong, because the company predicted $56 billion in AI chip revenue. That's falling short of $57 billion is what was estimated. So for Broadcom in particular, do you think maybe investors are overreacting a little bit to the latest quarterly results and the revenue forecast moving forward?
Well, I think that space has gotten rather competitive, right? So it used to be the NVIDIA show for a few years. It was all about GPUs. Broadcom is unique. I like it because it's sort of the web of other things that kind of connect all of this. And it's a bit sort of, it's a part of Google's success and TPUs and other people's sort of efforts to get into this business. So I think it's a very, very good business. I think it's just that it's the expectation has been so high based on very valid euphoria in the space as AI continues to expand. But there are the re-rating has happened, right? So the excitement has happened, the runs in these stocks. We've seen some of these semiconductor stocks run up, 100% in rather short order. And we've seen the euphoria switch into other areas of the market where maybe areas have not been re-rated. So for example, in the CPU space, in the equipment space, a stock like Dell, where the street didn't appreciate what is happening from the sort of endless AI demand, and they've sort of looked at that and said, "Oh my gosh," scratching their head. And said, wow, this is something that needs to be re-rated. So we're sort of seeing this bit of, jumping over each other, figuring out what's the next area of AI to re-rate, so that from the perspective of everybody saying, wow, we didn't realize that was going on. So I think the re-rating happened in semiconductors. It's had a fantastic run, and because of the exuberance I'm seeing in the option space, you can see people have gotten a little bit too excited. And when you get too many people on one side of the boat, well, it can tip over a little bit.
Okay, let's move on a little bit to SpaceX, because it's planning to IPO next week to raise money to fund its AI build-out. So still talking about AI here, but how do you think the concerns about the tech industry right now will kind of affect the initial listing next week for a company like SpaceX?
I'm not super excited about this. I think it could be somewhat destabilizing. I think that if you sort of look at this, there have been ways to get involved in SpaceX for a very long time. So typically with some of these IPOs, some of the funds that get involved on the IPO have already pre-bought. So you've had this availability of stock. So the sort of buyer that we typically get for these IPOs is already in and maybe looking to exit. And they're sort of changing some of the rules, making it easier to exit. These lockup periods aren't as long. They're starting to mess with some of the rules. It's a little bit... It's a little bit stinky, in my opinion, and I do worry about this. It's a company that doesn't make money. OpenAI doesn't make money. Anthropic doesn't make money. So we're taking on these absolutely record-breaking IPOs, and eventually they potentially go into the index as well. So I think what we're seeing is we're seeing a little bit of a pullback in some of the other names that are very liquid, these Mag 7 stocks, in order to raise money to basically buy SpaceX. In my view, anything can happen. This is going to be an incredibly interesting IPO to watch. But in my opinion, it's been trading at $2.4 trillion in the sort of dark market. That's a little bit high for what this company does. So, and I think it can be destabilizing, because we are talking about by far massive amounts of stock being put into the market.
Mm-hmm. Okay, I want to stay on tech stocks for a moment, because one of your picks for today is Apple. So tell us why that's one of your picks for today. What is it? What opportunity do you really see with Apple moving forward?
So I've loved Apple for a long time, and a lot of people criticized Apple because they're not spending, right? So we've gone through these phases of, people are spending on CapEx, on AI. That's a great thing. And then suddenly it's a terrible thing because we're not seeing the return on investment. For Apple, they've been sort of sitting back and waiting for AI to come to them. And I think they don't need to spend. And I think that puts them in a powerful position. It's not a cheap stock, but we've seen Mac Minis, Mac Studios selling out because of agentic AI. So they have a chip, it's the M5 chip. It's a kind of GPU, CPU. We were talking about GPUs and CPUs earlier. So I think Apple really monetizes this cycle, the AI in your pocket. They have a very rabid fan base. They're willing to pay beautiful margins to have this very chic product. And I think Apple is the sort of the dark horse part of that has been the actual desktops, the notebooks, the Mac Minis and Studios that are doing well, because they are very attuned to this new agentic AI phase of things, just in terms of their hardware capabilities. So I think they continue to do well. AI in your pocket, Apple's going to absolutely benefit from that.
Okay, we'll have to leave it there. Hans Albrecht, equity fund manager at Option Pit. Really appreciate you joining us today. Thanks so much.
Thanks, Lindsay.
Coming up, crypto has been seeing some pressure amid the ongoing tensions in the Middle East. We'll get more on that when we come back. Stay with us. Crypto is under pressure as Middle East tensions rise. New U.S. sanctions on Iran target crypto exchanges, raising questions about whether this is just a pullback or a deeper geopolitical shift. For more, we sat down earlier with Sean Bill, Chief Investment Officer at Bitcoin Standard Treasury Company.
It is definitely affected by the rise in geopolitical risk. I think also, some of the uncertainty here on the Clarity Act in the United States is also contributing to this sell-off. But we do view it as a longer term, great opportunity for Bitcoin investors, great buying opportunity.
U.S. authorities are trying to limit Iran's access to global financial systems, including crypto. I wonder what that does. Does this signal that digital assets are now firmly on the radar of policymakers politically? And how much does that change an investment case for crypto if that's the case?
Yeah, we've definitely seen with the current administration that they're spending a lot more time and attention to try to, create a framework to regulate crypto assets, and in particular Bitcoin and a few others. We think that's a positive development overall. Obviously, the tensions in the Middle East and trying to, enforce sanctions over there, that's a separate issue on the geopolitical side, and hopefully that will be resolved before too long. But we do think that what you're seeing right now is a greater adoption. We just had an announcement from the CME on a 24/7 trading capability. We just got a no action letter for Coinbase to be able to now offer Deribit to U.S. investors, which is a very popular overseas exchange. These things are definitely, I think, very positive, strong indicators for the regulatory environment generally improving for the outlook for Bitcoin. Of course, there are these bumps in the roads with things like the Straits of Hormuz, but in general, we think it's a very favorable environment for Bitcoin.
Going back to that kind of the tone that maybe now it's on more people's radars, cryptocurrency. Does that come with any risks at all? I understand it's mostly benefits, but is there any kind of risks that comes with?
Yeah, I think we've seen that, recently here in the last several weeks, we've seen some outflows from ETFs, which tend to be more retail driven, but there's also a lot of institutional adoption going in through ETFs. So we've seen, it's become a little easier to move in and out of Bitcoin in the last year or so. And, that does create a little more of a risk on, risk off characteristic than what we had traditionally. But in general, that means that you are more affected by these geopolitical events than you may have been in the past. Now, right now, we kind of feel like, Bitcoin's getting into a very interesting zone. There's a 200-week moving average down here, about 62,000. We think that'll be really strong support for the market. And what the market feels like what's going on right now is that we may be looking at a retest of that February 6th low that occurred at 61,000. And we'll see how the market handles that. And, I think another big factor besides just all the geopolitical tensions has been a rotation. You have a rotation that's been occurring going into AI stocks, going into semiconductor stocks, et cetera. And I think, some of the retail investors will chase the shiny object, right? And so I think that's also been a part of the flows out of Bitcoin, going into other risk-on assets.
Got it. In times of sell-off, though, investors do tend to move towards what feels safest. Where are they flocking to right now? Are you noticing any trends within cryptocurrency?
Well, I'd say right now that we've had a little bit of an outflow from the cryptocurrency markets. Mm-hmm. I think Bitcoin's actually been one of the strongest performers within the currency market, Bitcoin crypto markets. You probably seen some flows into stable coins. You're seeing some flows. You've noticed probably that the treasury rates have come back in a bit, on the yields, which would probably indicate that we're seeing some rotation into safer assets like treasuries. And then, of course, we watch what's going on with gold, which has been generally a very strong performer overall. I think, we look at Bitcoin as kind of a store value asset. We're in a little bit of a correction mode here for the last several months, but we do view it long term as it's a kind of like digital gold. And it's a store of value. And we think that, long term, if you have a longer term horizon, that, Bitcoin's a great addition to a portfolio. It still has a very fat right tail on return distributions, and it still generally holds a lower correlation to other assets.
As you mentioned, you expect to maybe see somewhere around the February lows coming up. So with that in mind, where should investors be looking? What should investors be looking at in the days and weeks ahead?
Yeah, I think for investors, we definitely want to watch how the market handles this level down here, call it between 60 to 63,000. There's a 200-week moving average coming in at 61,888. There's a big channel support trend line coming in just above the 200-week moving average. But it wouldn't be unusual for a market, to go back and retest a low before it enters into a new bull market. And so that's what we're kind of watching here at BSTR. We want to see how it handles these levels. And then, big picture wise, we think that it's we're getting ready to go public. And so the idea that we may be able to convert fiat into Bitcoin at, below 70,000 to us is a gift, the way we look at long term.
That was Sean Bill, Chief Investment Officer at Bitcoin Standard Treasury Company. Up next, Macy's is pointing to momentum in its business as it looks ahead. We'll get you a conversation with the CEO right after the break. Macy's raised its full-year outlook, signaling confidence in its strategy to strengthen its product mix and expand its higher-end offerings. Earlier, Bloomberg spoke with Macy's CEO Tony Spring and discussed the company's earnings, consumer spending trends, and the outlook for retail sales. Here's more on that conversation.
We feel like we are on the curve of beginning to transform the Macy's Inc. portfolio company.
The conversation was a bit different even a year ago. I mean, people were writing your obituary, the Macy's obituary. They were writing the department store obituary. Is this turnaround just about a better experience in the stores, or is it about something different that we're not really picking up on?
Well, I never bought into the extinction of department stores. I think it's bad stores don't have a place in the retail ecosystem. Sometimes they can survive longer than they should. Great stores people love. People love Harrods, they love Selfridges, they love their department stores. We're a department store. We do a really good job. When we do, we get credit from the consumer. When we don't get credit from the consumer. So I really just took it internally and challenged our team to say, let's satisfy the customer. Let's put people back in the stores. Let's update the product mix. Let's do a little storytelling on the visuals. How about some help in the fitting room where the customer is craving support once she's taken her clothes off and is looking to figure out what size is going to work for her.
So customers seem to be a little bit more excited about what's going on. I am curious about the brands, the vendors, the things you sell there. Are they also excited? I mean, are you seeing more interest from brands that maybe had left the Macy's ecosystem in the past and maybe are knocking back on your door?
Yeah, we've talked about new brands coming in, Donna Karan Weekend, Rothy's new to both Macy's and Bloomingdale's, the addition of Ted Baker and Theory and Reese. Bloomingdale's certainly big luxury expansion. So I think the brands we're looking to see, are you ready to take care of the business? Will you be accretive to my brand positioning? Will you help me to reach customers I can't reach without your support? And I think the team has done a good job of explaining that. Macy's 38 million active customers. That is not easy to buy in the media market. So how do we make sure that we're presenting our brand in the right way so that we're capturing new customers, that maybe we're the first time that they're learning about our brand, and that we're proud of the level of business we do?
I am curious. One of the big criticisms of your Bold New Chapter, your turnaround plan, is that you're basically shrinking. The idea that you're leaning too heavily on Bloomingdale's, which is obviously a success story. And there are a lot of people that want to know, is this sort of a big structural shift for you with regards to what Macy's Inc. overall is going to be? Is it going to be weighted more towards luxury and Bloomingdale's, or is it going to be the complete sort of ecosystem, Macy's, Bloomingdale's, and Bluemercury?
Well, it's a three-part strategy from the very beginning. The first chapter of Bold New Chapter was strengthen and reimagine Macy's. And while we had to close some stores, we still have a few more stores to close, the primary focus was reimagining stores. I think when you and I talked the last time, I said a strategy is not a strategy if it's just about closing underproductive stores or monetizing assets. The strategy is making it better for the consumers. So we put more people in the stores, we added more inventory, we brought in new brands, we made the website more inspirational. But the second part of the chapter is to grow Bloomingdale's, because why wouldn't we? We own Bloomingdale's. It's a great brand and has so much potential, organic potential, physical potential, digital potential. And then the third piece of the strategy was to make sure that we were operating efficiently and effectively and serving the customer. So I'm proud of the fact that the supply chain team, we're in stock better, we're flowing inventory to the customer faster, we're having less issues with the consumer. That's why our net promoter scores, how we measure customer service, are going up.
Bloomingdale's growth, there are some people that said, certainly in the most recent quarters, has benefited partly from, let's just say, the relative absence of Saks Global, Neiman Marcus, Bergdorf, Saks. They're in bankruptcy proceedings. They are expected to come out sometime this year. And I've spoken with their CEO, and he's got some pretty ambitious plans for what he thinks Saks can be. Does that potential increase in competition worry you with regards to Bloomingdale's trajectory?
No, I'm focused on Bloomingdale's. I'm focused on Olivier and his team.
You don't go into Saks?
Oh, I certainly shop the competition, but I'm focused on what we do. You know, I learned a long time ago, if you depend on other people failing for you to succeed, you're not going to get very far. Our focus is on delivering a great experience for the Bloomingdale's customer. You and I could go over and walk 59th Street across the street from this great building and see new brands, great people, great visuals, inspiring marketing, 40 carats yogurt. There's so much interest within the Bloomingdale's brand. Does competitive missteps help Bloomingdale's?
Yeah.
Of course. But if Bloomingdale's wasn't running effectively, wasn't healthy, and this strategy started a number of years ago as we added new brands, as we declared our right and reason for being at our 150th anniversary in 2022, we said, we can do better.
Yeah, also just as a personal note, they had a Sun Life pop up there, by the way. You need to get that back. It was only temporary. In all seriousness, I do want to ask you about just the consumer overall. I mean, it's one thing to say, okay, your business is doing great. There are certain things you control. You don't necessarily control the economy. Gas prices are significantly higher than where they were 3 months ago. Most economists don't think they're coming down anytime soon. You already had a consumer, as you have characterized in the past, as being kind of a K-shaped or even E-shaped economy here. Do you see the state of the U.S. consumer improving anytime soon?
I think the consumer is going to continue to buy rewards and things that they can enjoy, find a way to escape. We talk about retail escapism or retail therapy. And the gas prices being higher is not helpful to the business. There's no question. But it's not an excuse to not do business. Every single day, we are doing business at Macy's and Bloomingdale's and Bluemercury. How much business? How do we take business from the competition? How do we inspire you to find things? So if we have a new brand in sunglasses, if we have a new Hoka sneaker, if we have a new pair of Page denim jeans, there's a reason for you to buy. And by the way, we're actually accessible luxury. We are in categories that, for the most part, our core customer can buy multiple times without putting a dent in their wallet.
Okay, here's a look at the markets before we go to break, before the opening bells. This is the futures. Obviously, you can see the Dow is up. The NASDAQ and the S&P 500 both down today. We'll continue to talk about that. Broadcom's latest results really fueling the kind of sell-off that we're seeing, particularly in the NASDAQ. We're also watching the price of oil this morning. It is falling after word of a conditional ceasefire between Israel and Lebanon, which could, in turn, help Iran and the U.S. come to a potential peace deal. So oil down more than 3%. Gold on the flip side for the same reason, edging higher as traders weigh this potential kind of headway that might be happening in the Middle East. And we're also watching the loonie, which is following the U.S. dollar, weaker against other G10 currencies on the hopes of a potential moderation in the Middle East because of what we're seeing between Israel and Lebanon. And then Bitcoin, too, we're watching that. It's lower still. And this is actually the longest losing streak since April. So we'll keep watching that as well. Stay with us. The opening bells are next. Here are the opening bells. At the NASDAQ, INEO Group is ringing the opening bell this morning. On the New York Stock Exchange, Sunshine Silver Mining and Refining Company is celebrating their initial public offering. And on the TSX, Adiro Clean Technologies is opening the market to celebrate the company's new listing on the TSX. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we're going to check in on the equity markets to start your day. Starting off with the North American markets. We'll take a look at them now. A bit of a mixed bag out there, but the TSX is up to start the morning after seeing some losses yesterday, up by 0.3%. S&P 500 down. The NASDAQ also down by more than a full percentage point. We'll be talking about that a lot throughout the morning. It seems investors might have might be a little concerned that they've overdone it when it comes to tech stocks and the tech rally that we've been seeing. But first, we'll start with the TSX and some companies on the TSX that we're watching closely. Ivanhoe Mines has reported a monthly production record of zinc at its Kipushi mine in the Democratic Republic of Congo. That mine is now on track to become the world's 4th largest zinc producer. And so we're watching this company closely because this comes as zinc prices have reached a 4-year high. So Ivanhoe Mines starting the day off in the green ever so slightly, up by 0.3%. And we're also watching Strathcona Resources. Jefferies analyst has upgraded Strathcona to a buy from a hold with a price target of $56 Canadian. That's up from 45. The firm says the company's asset base and organic growth plan is not fully appreciated at current share levels. You can see Strathcona at this point down more than a full percentage point. And Athabasca Oil, we're watching that company too. Jefferies has initiated coverage of Athabasca with a buy rating at $14 Canadian price target. The firm says Leismer expansion should drive near-term growth, while Corner should add higher quality production by 2030. And you can see Athabasca is down to start the morning. If we take a look at some stocks south of the border, Broadcom, obviously, as I mentioned already, one we're watching closely. It's down almost 15% to start the day. Shares were falling in the pre-market. The company is now set for its biggest drop in over a year. This comes after it reported a forecast of artificial intelligence chip revenue that missed estimates. And it seems as though this is sparking a kind of broader fear for investors in terms of maybe they've overdone it when it comes to the tech rally recently. So Broadcom down. We'll continue to talk about that quite a bit this morning. We're also watching CrowdStrike, which is falling as the security software company's first quarter beat was not strong enough to lift the stock, which is more than doubled from a March low. CrowdStrike down almost 10% as well. And PVH, that's another one. It's down, wow, almost 30% to start the morning. This comes after reaffirmed adjusted earnings per share guidance from the owner of the Calvin Klein and Tommy Hilfiger brands missed consensus estimates. Analysts note sustained pressures from the Middle East conflict are affecting that as well. And we're also watching Five Below, which is falling after the retailer reported results. It's down almost 10% to start the day. The quarter was a standout, apparently, quote, but the growth rate might be peaking, according to Jefferies. Coming up, we will check in on the markets and get some ideas for your portfolio. Stay with us. Shares of Broadcom are under pressure after the semiconductor and software maker issued guidance that failed to live up to investors' expectations. That's having a cascading effect through other stocks tied to AI. So let's get some perspective on the AI theme as a whole, as well as Broadcom. Joining me now is James Learmonth, Co-Chief Investment Officer and Portfolio Manager at Harvest ETFs. Good morning. Great to have you join us.
Good morning. Thanks for having me.
What do you make of the reaction to Broadcom's latest earnings results to start? And do you think investors are maybe overreacting a little bit?
Yeah, I think with regards to Broadcom, what we're really seeing here is strong results meeting extremely high expectations. And it never feels good, but fortunately, it's actually healthy for stocks over the longer term. At Harvest, we're focused on long-term investments, and so through that lens, Broadcom still very much meets what we consider to be the qualifications of a technology leader.
Can you elaborate on why you feel that's healthy for a stock in the longer term?
Similar to what we've seen over the past couple of weeks, it's very easy for expectations to get well ahead of reality. And so particularly the past 4 weeks or so, we've seen stocks gap up on a rapidly evolving AI environment. And so it's important for investors to get that gut check, so to speak, to reevaluate their long-term thesis on stocks. And ultimately, over the long term, it tends to make bull market advances much more sustainable.
Okay, so we're seeing a bit of a sell-off in the tech sector today as a result of what Broadcom reported. What are your thoughts on the kind of general tech rally that we saw lately that seems to have maybe come to, has it come to an end now, or is this just a blip that we're seeing today?
No, I think this is just a normal, healthy correction. Investment in AI is still very strong. We've seen examples of companies continuing to invest strongly, like just a couple of days ago, Google announcing for the first time in a very long time the issuance of equities in order to support their spending levels. we think this is going to continue for a while, but keeping in mind it is a rapidly evolving theme, even within such a narrow focus. A couple of years ago, the AI theme was predominantly about NVIDIA and GPUs. Then that turned to looking at storage and memory semiconductor stocks as a key driver. More recently, networking equipment and servers and CPUs, traditional CPUs like those made by AMD and Intel, have become key components of agentic computing.
Where do you think that's? Oh, sorry. Continue.
No, go ahead.
Well,
please.
where do you think that story is going to go next? Like when it comes to the AI theme, as you say, it's rapidly evolving. Where are you looking forward to in AI, and what companies or I guess sectors do you think are going to play a part?
I think specifically within AI or within technology, I think hardware is still probably the place to be invested. They're the primary beneficiaries of all this spending coming through. But it is important, even within such a narrow focus, to remain diversified. We saw a very violent rally in software stocks last week as some of those investor concerns about significant disruption from AI sort of faded into the background. And so it's important to remain diversified. When we look outside of the technology sector, we see a lot of different areas that are starting to see benefits from the significant amount of spending that's going into AI and to support AI infrastructure.
What areas are you liking right now in terms of sectors?
I think there's some opportunities in industrials. One of our favorite names there is Caterpillar. They've been benefiting primarily from significant investment in power generation. So they make turbines that go into to gas power plants, as well as backup generators that are being used to support the power needs of data centers. But more broadly, and looking forward, we're starting to see signs of reacceleration in the U.S. economy. And Caterpillar's business is ideally suited to benefit from that as well with their large businesses in construction equipment and mining equipment.
Okay, and you also like NVIDIA, because Caterpillar was one of your stock picks for today. We talked about that. You like NVIDIA as well. What is it that you like about NVIDIA?
I do. Obviously, NVIDIA has not been the standout performer within the AI theme over the past several months that it was just a few years ago. And I think those days of kind of 30% reactions in the stock to strong earnings are probably in the past. But what we have seen is the earnings multiple for NVIDIA has actually come down significantly over the past few months as well, as investors have started to price in that transition into a more mature growth phase. What one of our clients, I like to paraphrase, called NVIDIA moving into its Apple years. So we expect strong growth to continue there, and that should continue to propel the stock price over time, because NVIDIA does remain a key player within the AI infrastructure theme.
I'm wondering what your approach to investing at a time when there's a lot of uncertainty, caused by geopolitics is. You were talking earlier about diversifying. I'm sure that's part of it. And when you diversify, we talked about the sectors you like, but is there anything you think investors should be staying well away from right now?
I think by and large, diversification really is key. We've been advocating a barbell approach to the markets for this year. We still very much like technology, and we think you want to have an allocation to that theme and to growth in general. But you want to balance that with some more defensive areas like healthcare, which are trading at historically low valuations. I'm not a fixed income guy. I'm a little bit more concerned about the potential for reacceleration in inflation, particularly. And so, particularly looking at the long end of the bond curve, that makes me a little bit nervous out there. I'd be a little bit more cautious out at that end of the spectrum.
And just lastly, aside from AI, are you optimistic about the broad U.S. equity markets right now and the direction they're going in?
Very much so. Very much so. We think that, as I mentioned, the U.S. economy is starting to show signs of reacceleration more broadly. We're seeing that in some of the soft manufacturing data, like the survey data coming out. We're seeing signs that the labor market is starting to improve. We'll get the non-farm payroll numbers tomorrow and see if it confirms that. But we've also got a tremendous amount of both fiscal and monetary stimulus in the form of tax cuts and business investment incentives from the One Big Beautiful Bill Act last year, as well as the interest rate cuts that the Fed did over the past couple of years that are just now starting to filter into the economy. And so we think that will continue to drive markets and should drive broader participation, which I think will make the market a healthier investment opportunity overall.
Okay, James Learmonth, Co-Chief Investment Officer and Portfolio Manager at Harvest ETFs. Thanks so much for your time. Appreciate it.
Thanks for having me.
Yesterday on Market Call, we were joined by David Burrows. He is Chairman and CEO of Barometer Capital Management, and he was covering North American large caps. These were his top picks: Bombardier, BHP Group, and Tamarack Valley Energy. Today on the show, we have Darren Sissons. He is the partner and portfolio manager at Campbell, Lee & Ross Investment Management, and he'll be taking your questions on global and technology stocks. When we come back, we will sit down with the CEO of Canaccord Genuity after the wealth management company beat in its fourth quarter earnings. We've got more after this. Canaccord Genuity, a Canadian investment banking firm with operations in 10 countries, beat analyst estimates in its fourth quarter, with revenue up just over 30% year over year. So let's get more from Dan Daviau, CEO of Canaccord Genuity. It's great to have you join us. Good morning.
Thanks, Lindsay. Thanks for having me.
So I guess walk us through, first of all, what the biggest growth drivers were in this quarter that you saw.
It was a good quarter right across the board. Obviously, we've invested an immense amount of resources in our wealth business. Our wealth business continues to grow substantially, almost $150 billion in assets in that business, and Canada's been a great driver of that. But it's also, we've had a pretty constructive capital markets business here for the last little while. We're seeing a return to risk in the market. You were talking about that with your previous guest. There's, more money being deployed in the capital markets, and we're seeing some entrepreneurial companies now start to raise money, particularly in Canada and Australia. So that was very helpful too to our quarter.
I did want to talk about Canada and Australia, actually, those wealth platforms. How do you assess the outlook in terms of margin expansion and competitive positioning moving forward for Canada and Australia in particular?
Great. Both of those markets are phenomenal markets for us. In Canada, we are the dominant non-bank wealth platform in this country. We call it independent platform. And this is a business that started, we started growing it 10 years ago. It was $8 billion in assets. It's almost $60 billion. It's $55 billion in assets now. So it's increased materially. And we represent a great platform for the people who don't want to work at the banks to work at. We've got a full service offering here. We've got a great reputation and a great platform for people to come over and work for us. So that's worked out very well. And we also give them the tools. So they've been able to grow that business substantially. So, we've had an immense amount of success. It's a very, very profitable business. We're replicating that success that we've had in Canada and Australia. In Australia 5 years ago, we had a $1 billion business. Today, that's an $18 billion business. We made 2 acquisitions in that business, including one, Wilson's Advisory, which we just closed, and it's worked out very well. So now we've got a profitable, growing business in Australia, and it's the same dynamics there. If you're looking for an independent platform that can give you all the tools you need, we're attracting new advisors to that platform. We've got offices right across the country, a big national footprint in Australia, and we see significant growth in that market as well.
What are some of the headwinds, though, particularly for your Canadian and Australian market? Would it be raising interest rates?
From the wealth side of our business, there's no particular headwinds. Rising interest rates is interesting, but and it could ultimately hurt the market a little bit. But these are a lot of this is discretionary portfolios or managed portfolios. They'll switch their investments from things that are from more interest rate sensitive to less interest rate sensitive. So those aren't going to be particular headwinds. I don't want to say we don't see headwinds, because there's headwinds in all businesses. But as long as people continue to deploy money in the capital, in the market, there's no headwinds. That business is growing substantially. Our average advisory team in Canada now is almost $400 million, a 30% increase. There's no natural headwinds in the business. We just got to stay out of our own way and let our entrepreneurial advisors do what they can do.
What about for capital markets, though? Because I heard you say on the earnings call the capital markets is tough to predict compared to your wealth management side of the business. Can you elaborate?
Question, and you're absolutely right. There is potential headwinds in any capital markets business, and that really is a function. The sectors we serve are the entrepreneurial sectors. Whether it's the early stage mining companies or technology companies or sustainability companies, it's the companies that drive the economy. And obviously, when the economy is a little bit more circumspect, though, the capital being deployed towards those sectors goes up and down. So those are more volatile and they're harder to predict. We've been very successful in doing it. We continue to see, good success in the next couple of quarters, but we just can't sit here. And if you heard the earnings call, you're right. We just can't sit here and project that 6 months in advance. It's a tougher thing to do. So you're right from that perspective.
When it comes to any recent pressure on private credit, though, how does that influence the way Canaccord advises clients?
Yeah, no, that's another great question, Lindsay. Private credit, what that drives mainly is M&A, right? When you buy something, you got to pay for it. You either pay for it with your stock or you pay for it with debt. And a lot of that debt, if you're not a bank client, if you're a more risky client than the banks would otherwise do business with, which are more or less many of our entrepreneurial clients, they need to get the credit from somewhere, and they get the credit from private credit. As that market backs up, it could slow down M&A. We're not seeing that right now. Maybe on the tangent we are seeing it, but that's where that business would be impacted, in our M&A business, which had a significant increase. I mean, in Canada, that business was up almost 300% year over year. So that could impact that business going forward. We don't see it right now, but obviously that could be something that happens.
Yeah, and you did say as well in your earnings call that your M&A pipeline continues to be really strong. I know you said you closed Wilson's Advisory, but do you have any other any acquisitions or mergers coming up this year or the next year?
Always looking at things, but from our perspective, it's a cultural thing as much as anything else. So, there's things that could make sense on paper that don't make sense, over a dinner, if you know what I mean. So, we've got employees are by far our most important asset in our business. We own a significant chunk of our public company, 46%. We continue to increase the ownership in our company. So if we're bringing on a new firm, it's got to fit culturally in our business, and I think that's the biggest criteria.
I want to bring AI into this, of course. Where does Canaccord see the most AI-driven investment opportunities moving forward?
If you look at AI, if you search in Claude or you search in 365 or Copilot, and you say, what's the business that can most benefit from AI? One of the top 3 businesses they'll say is wealth management. And so if you just ask AI the question, that's what you get back. And we see that. We see AI as a significant tool in our wealth management business, making it more efficient, making the advice you give clients better, and be able to service more clients with a fixed number of people. So we're deploying a lot of resources around AI. It's a significant effort in our business. There's licenses right across the business, but it's still cutting edge, and how exactly it gets used inside the business is changing. Mainly, it's going towards our back office functions and towards our wealth management functions, but we're increasingly using it in investment banking as well. It's an important tool that helps us advise clients.
Okay, we'll leave it there for now. Dan Davio, CEO of Canaccord Genuity. I appreciate you joining us today. Thanks so much.
Thanks for having me, Lindsay.
Coming up, stay tuned for the latest market update on Wall and Bay Street right after this. Stay with us. The Trump administration is taking a new approach to global tariffs after the U.S. Supreme Court struck down previous ones earlier this year. The focus now is on curbing imports made with forced labor and a proposed new 10% tariff on Canada and other trading partners who allegedly failed to comply. CTV's Abigail Beeman has more on Canada's reaction and the shifting goalposts on trade.
Hello. Just hours after the U.S.-Canada trade minister said he had a positive meeting with Jameson Greer, Greer put Canada on the list of countries that could be hit with a new 10% tariff. The failure of our most important trading partners to address the importation of goods made with forced labor is unacceptable. This creates a dynamic where American workers are forced to compete globally on an unlevel playing field, Greer said.
This is not a surprise.
The Prime Minister pointed out the vast majority of goods fall under the Canada-U.S.-Mexico free trade deal and won't be impacted. He says Canada supports the overall objective.
We made some changes earlier this year on things that candidly were not as effective, so there's ways we can change things legislatively. We'll be proposing that to the House in the coming weeks.
It's not about forced labor. It's about finding a new reason, any reason they can, to apply a tariff on Canada and the world to harm our economies. It's just like the fentanyl tariffs.
LeBlanc wouldn't answer whether he and Greer discussed Canada's move to allow some Chinese EVs into the market.
We don't discuss publicly the content of private conversations.
This administration is willing to use any leverage it has in order to get Canada or any other country to do what it wants.
U.S.-Canada expert Christopher Sands says the U.S. is intentionally moving some trade irritants outside CUSMA, or as it's known here, the USMCA.
The good news is that might mean the USMCA could move as far as renewal, or that the negotiations could be more constructive going forward. The bad news is this is designed to keep the U.S. with leverage, even if we renew USMCA, because we have the other issues that we could use to impose tariffs on Canada.
Now, these tariffs aren't in place just yet. Experts say important to point out there is a process. The USTR will hold hearings about them July 7th. Abigail Beeman, CTV News, Washington.
Okay, we're going to take a quick look at North American markets to start the day. We'll take a look now. They were falling earlier today, at least the U.S. markets are. The TSX is up by 0.6%, S&P 500 and NASDAQ down today. There's a bit of a tech sell-off happening, mostly because of Broadcom reporting some earnings that missed estimates, and so it appears investors are feeling a little concerned about that. We'll talk about that in a moment. But we're also watching the price of oil today. It is falling after there's word of a conditional ceasefire between Israel and Lebanon, which could in turn help Iran and the U.S. come to a peace deal. That was one of the conditions for Iran at the time. You can see oil down almost 4%. On the flip side, gold is edging higher for the same reason, as traders are weighing this potential headway in the Middle East, potentially the Strait of Hormuz opening soon. You can see the price of gold up more than a full percentage point. And then we're also watching the loonie, which is following the U.S. dollar, weaker against other G10 currencies on the hopes of a moderation in the Middle East. Keep in mind, this talk of Israel and Lebanon reaching a ceasefire still comes as clashes persist in the Middle East, so we'll have to wait and see what happens there. We're watching a couple of different companies on the TSX today as well. Descartes Systems is one of those companies we're watching. It is actually top of the TSX to start the morning. The software company up almost 8% at the moment after Q1 earnings beat estimates, and this company reported higher profit and revenue moving forward. This comes after it was actually down in after-hours trading yesterday, so you can see it's getting a boost today. On the flip side of the TSX, Celestica is at the bottom, down significantly, almost 12% at the moment. No real reason why, but potentially because of what we've been seeing with Broadcom, which reported results that were below analyst estimates, and it seems as though investors are selling off some of their tech stocks today as a result. Just ahead, positioning your portfolio during the AI build-out. We've got more on that after this. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Shares of Canaccord Genuity are surging today. That's after the company posted higher than expected fourth quarter revenue, with that metric jumping 33% compared to the same period the year before. Profit also came in above expectations. Canaccord says the results were driven by higher investment banking, while wealth management continued to scale. And shares of Transcontinental are trading lower after profit fell in its most recent quarter. Lower revenue and higher financial expenses also impacted that period. The Montreal-based company also anticipates lower returns in its book printing sector for the remainder of 2026, but it says the closing of its packaging business will allow it to focus on its growth strategy. And shares of TransAlta are seeing a drop today. That company is buying 2 gas-fired power plants in Colorado. TransAlta says the $1 billion purchase from Blackstone will strengthen its foothold in the western U.S. The deal will also immediately add to free cash flow. And we're watching the TSX today. It seems to be gaining some ground after seeing some losses yesterday, up almost a full percentage point to start the morning. Not the same story for the U.S. markets. If we take a look at some of the big indices out there, you can see the S&P 500 and the NASDAQ. After reaching some record highs recently due to a tech stock rally, there seems to be a pullback today in tech stocks. You can see the NASDAQ is down by almost a full percentage point. The Dow Jones, however, up by 1.5%. And we're keeping an eye on the price of oil as well. There is reports that Israel and Lebanon have reached a ceasefire, which in turn could potentially lead to some headway in negotiations between the U.S. and Iran. And so potentially maybe reopening the Strait of Hormuz, and the price of oil down on that news, almost 4%. On the flip side, the price of gold seems to be rallying because of the news that there could potentially be some kind of development in what's going on between the U.S. and Iran. Gold is up more than a full percentage point. And we're also watching the loonie today, which is trading up now ever so slightly against its U.S. counterpart. Investors are hitting pause on the AI trade after Broadcom's earnings failed to impress. Let's get some perspective and some ideas on how to navigate the AI trade and where to find opportunities. Joining me now is Steve Rolls, Senior Portfolio Manager at Trivest Wealth Counsel. Good morning. It's great to have you.
Hi, Lindsay.
Hi.
Great.
So first of all, let's get your thoughts on the pullback following Broadcom's earnings results. It seems to be affecting the broader markets in total.
Yeah, it's a big pullback. It's not affecting the overall markets dramatically. It's more of a one-off. Really comes to the point of the earnings were actually pretty good at the semiconductor AI space. Actually, the revenues increased by about close to 80%. So everything was good on the beats for earnings and revenue. It was more on the outlook that for the rest of the year. They came up with expectations of 56 billion, where the market was looking for more, closer to 58. So it really dampened the mood a little bit. But overall, it's still quite a positive view for the company in the way that their outlook for 2027 fiscal year is at revenues of 100 billion. So while it's a big drop, you got to look at since March, it was hovering around 300, got close to 500. Now we're back down to 400. So it's really a state of this AI move is going to continue to be lumpy here.
Yeah, because I mean, still, Broadcom, I take your point that earnings were not actually that bad at all. It's just kind of falling on expectations, like really high expectations. Broadcom down, though, more than 15% today. So do you think investors are maybe overreacting a little bit, or is this a correction that needed to happen?
I don't consider a correction. I mean, we saw something similar with not as dramatic, but with NVIDIA when their euphoric results came out as well. So it's just a situation of what's happening in the market right now. It's not so much are they beating or their earnings looking back. It's more on the forward guidance. But the market is really, I think some of this comes from the CEO of Taiwan Semiconductor also mentioned today that the demand is too much, and that the AI chip makers are not going to be able to fully meet the demand. So with that as a problem, it's actually quite a positive for the market when you think about it, that there's so much demand for these chips that that the revenue backlog it continues to build. So missing by consensus on foreign guidance, it's 2026, and it's just a new sort of element that we're looking at in the market. So I'm still optimistic on the overall AI build.
Okay. So, and you say Broadcom not affecting the overall markets today. We're seeing the S&P 500 and the NASDAQ both down after reaching some record highs recently. What are your thoughts on what we're seeing today in terms of those markets? Why are they down, do you think, then?
Well, yeah, definitely. There's some questioning, there's some profit taking. But overall, that the market has been on a big tear this quarter, and days like today does pull back a little bit. It's sort of a slower time for earnings, so the market is just taking a breath right now, which in effect is quite healthy. But if one stock is down 15% and the S&P is down just 20 basis points, it's still pretty. Broadly speaking, it's quite a positive day. Good news out of geopolitical space. It continues to be as volatile as the AI space. So we're in a very interesting time right now. But the market overall still has a lot of tailwinds behind it, and the number one tailwind is the AI industrialization, and this is a real industrialization capex spend that is continuing to be a big tailwind for the market here.
Aside from AI and tech, do you think investors are overlooking other opportunities in the market right now?
Well, yeah, I'm sort of looking at the market as two realities. One is obviously the AI capex spend is creating an incredible tailwind down south, and it's important to get part of that. But the other factor is that with the geopolitical situation is really making the inflation situation even more stickier. So you have to ensure that you're protecting your portfolio by buying some real assets that are inflation protected. So I think what a lot of investors are doing right now is playing one or the other, and that's a bit of a dangerous game. I think the wise move is to be prudent by playing the market as a way of having some of the AI exposure through prudent cash flow proven stocks, as well as having some real assets, primarily some energy stocks and some pipelines.
Okay, I do want to get to your stock picks as well. One of them is Taiwan Semiconductor. You do own this one. You say it sits at the center of the entire AI ecosystem. Tell us more about why you like Taiwan Semiconductor.
Yeah, I like it because it's really the ultimate pick in the shovel. It's the company that makes the chips for all the chip makers. So it's well diversified, and it makes chips for NVIDIA, it makes chips for Google now, it makes chips for Broadcom. So it's the one play that with the AI growth and the capex spend, Taiwan Semiconductor is going to have that consistent revenue. Obviously, there's always some geopolitical risk with Taiwan and the China situation, but they have done a good job over the past couple of years of diversifying that by building some plants and some fabs in the U.S. So I think that's a good sign. But Taiwan Semiconductor, for me, is the poster child of AI capex spend growth.
Canadian Natural Resources is your next one. What opportunities, you also own this one, what opportunities do you see here?
It's one of my favorite companies. It's a Canadian company that is able to generate revenue in the States, and with the demand for energy in the U.S., I think that the continued demand looks well, good cash flow, incredible capital discipline, buybacks, good dividend. I think it's coming back close to $70 near the year high. So it's just one of these well-run companies that benefits from the U.S. growth.
Enbridge, potentially another one. You own this one as well, just to say that. What is it? What opportunities do you see with Enbridge?
Similar philosophy. It's more of moving the acquisitions that they're making in the U.S. is phenomenal. I think the pipeline growth in the U.S. is great. Really getting that LNG to the Gulf. How are they going to do it? Well, Enbridge is a key component in that, in getting that LNG right to where it needs to go. So it's an incredible company that is really able to optimize the Canadian energy by using the U.S. as a source. So it's not the pipeline debates don't really have to get included in the Enbridge situation right now, because they're moving full steam ahead in the United States.
Interesting. Okay, we're going to have to leave it there. Steve Rose, Senior Portfolio Manager at Trivest Wealth Counsel. Appreciate your time. Thanks for joining us.
Great. Thanks, Lindsay.
Still ahead, with workplaces requiring more employees back in office, we'll speak to our next guest on how that's affecting employment trends. Stay with us. With workplaces requiring more employees back in office, we're taking a look at the impact on employees ahead of the latest employment data. And to discuss further, we were joined by Tammy Sherrill, Professor of Economics at Wilfrid Laurier University.
It turns out Statistics Canada hasn't published a consistent series on this since last May of 2025. And so when I'm looking for those numbers, I'm trying to patch together a few different things. We've seen mandates from the federal government trying to bring people back into the office. There's some logistics there that are having some challenges. Some provinces are pushing for people to be back in 5 days a week, but some others are giving that flexibility and letting people stay home, say 2 or 3 days a week. So there's sort of a mixed bag of what's going on in the public sector and similarly in the private sector. More innovative, younger firms, they're embracing the work from home, where some of the larger, older institutions, they're trying to rein people in. From the data that we have, it looks like we're staying steady with people having at least some work from home provisions. Maybe it's 2 days a week, 1 day a week, maybe entirely days of the week, where roughly 20% of men and 25% of women have been working from home. And that seems pretty steady since about 2023.
Yeah, Tammy, I'm curious, like, and you bring up the statistics, which are it seems like a bit wishy-washy right now. I'm curious on, like, whether or not you think companies are actually measuring productivity and the evidence behind bringing people back, or is this just, are they counting butts and seats at this point? Or is there any evidence that's justifying what they're doing?
So from the evidence that we've seen, there's a bit of a mixed bag here, right? Yeah. We've got the anecdotes where, people own these big office buildings. Provincial governments have these big office buildings. They're like, nobody's in them. We need to fill them. It's like, well, that's not really a good reason to fill the building with those particular workers. Maybe you could find a better way to use it. This isn't necessarily going to be a productivity gain. For a lot of these younger firms, they're embracing the work from home and making sure that they can use it to increase their productivity. They're doing well there. For some people and some firms, there's real productivity gains to coming into the office, at least part of the week, so that you have that chance to network. And for young people, they get that chance to gain some mentoring, get those chats that, get work going and that on-the-job training. So the evidence here is a bit mixed. It's kind of it depends on who you are and how well you really plan out your workforce. There are productivity gains there to be had, both for workers in their own lives and also for the firms, but it's certainly not for everyone.
And so it does sound really difficult to find the right balance for it. The one thing I heard was with the mentoring, people just aren't learning as much because there's no one to talk to. In that you go to grab a coffee or you go to grab something, that's when you have those conversations where you pick things up. What kind of an impact is this having on the employees, that they're coming back in? They've gotten used to certain things. Now all of a sudden they're being told they got to be back in 3, 4, even 5 days a week. That they've adjusted their life. What kind of an impact is this having for them?
So again, I think this is it depends kind of thing, right? There's a lot of differences across the market. If you're a young person who's, making your way into the office, you might have had to change where you're living and change your plans quite a bit. If you're a young family, parents, they were the ones who really appreciated those work from home options, that flexibility it gave to be able to manage kids drop off, pick up, the sick days, the soccer practices, and everything that comes with it, right? Rather than spending a couple hours a day on the highway, they could do these things with their families. And so that's going to be the big adjustment that I think most families are trying to make right now. It's going to eliminate a lot of opportunities for some families where, adding in that commute every day just isn't a good option. They're going to be looking for other options. So I think some people, especially, if you're looking at some of your best employees who really enjoyed those work from home flexible options, they're going to be looking for those options with somebody else. And there are plenty of employers still offering it. So I think that in the long run, there's going to be some adjustments made in the market here.
We've talked a lot. I've talked a lot about people being social animals and really craving more community, and especially in this post-pandemic world. And one of the traditional places people found that community was in the workplace. So do you have any concerns about if companies are staying at more of a work from home type of a situation that there's social isolation that's going to continue on and the impacts of what that might be, not just in the next few years, but down the road 5 to 10 years from now and even further?
Well, on one hand, I think my impression is that there are some employers who have embraced that flexibility and work from home and just are very intentional in bringing together their employees, whether that's online or in person. When they plan an in-person day, it's very intentional to make sure that everybody sees each other. There's other employers who just have people showing up in the office and people sit alone in their office all day. This isn't working out well for anyone. And so, again, there's that mixed bag. But outside the office, maybe you have better opportunities now for that social contact that isn't just your work. And so perhaps, Canadians can embrace their identity as something other than workers in an office and develop those networks elsewhere.
And now you mentioned people having options to look elsewhere for jobs with unemployment at 6.9%. How many options are there? Or is it easy for people to move with the situation, or with that unemployment rate where it's at, it's not as easy? People are kind of stuck where they are to a degree.
It's certainly not as easy right now as it would have been a couple of years ago. I mean, the unemployment rate's been hovering between 6.4 and 7.1% for the past 2 years. So 6.9% is kind of normal for the past couple of years. lot more opportunity for moving around in, say, 2021, 2022, because everybody was doing it. So there was lots of job openings and places to look for. Right now, I think with everything that's going on in the world, you're talking about some of our, recession indicators they're out there right now. People are holding on, right? They know that it's difficult to find a job if they were to quit today and start looking for something. So they're going to be holding on to what they have. But there's many industries where there's still, upwards of half to 2/3 of workers having these options, and your best workers are going to be able to find those, especially the more experienced ones. If you're young and just starting out in the world, that's a big risk to take right now, to quit a job and try to look for something else. They're not finding the same types of opportunities.
That was Tammy Sherrill, professor of economics at Wilfrid Laurier University. Up next in the ETF report, a newly launched ETF and a few stock picks. Stay tuned. The Trump administration is taking a new approach to global tariffs after the U.S. Supreme Court struck down previous ones earlier this year. The focus now is on curbing imports made with forced labor and a proposed new 10% tariff on Canada and other trading partners who allegedly failed to comply. CTV's Abigail Beeman has more on Canada's reaction and the shifting goalposts on trade.
Hello. Just hours after the U.S.-Canada trade minister said he had a positive meeting with Jameson Greer, Greer put Canada on the list of countries that could be hit with a new 10% tariff. The failure of our most important trading partners to address the importation of goods made with forced labor is unacceptable. This creates a dynamic where American workers are forced to compete globally on an unlevel playing field, Greer said.
This is not a surprise.
The Prime Minister pointed out the vast majority of goods fall under the Canada-U.S.-Mexico free trade deal and won't be impacted. He says Canada supports the overall objective.
We made some changes earlier this year on things that candidly were not as effective, so there's ways we can change things legislatively. We'll be proposing that to the House in the coming weeks.
It's not about forced labor. It's about finding a new reason, any reason they can, to apply a tariff on Canada and the world to harm our economies. It's just like the fentanyl tariffs.
LeBlanc wouldn't answer whether he and Greer discussed Canada's move to allow some Chinese EVs into the market.
We don't discuss publicly the content of private conversations.
This administration is willing to use any leverage it has in order to get Canada or any other country to do what it wants.
U.S.-Canada expert Christopher Sands says the U.S. is intentionally moving some trade irritants outside CUSMA, or as it's known here, the USMCA.
The good news is that might mean the USMCA could move as far as renewal, or that the negotiations could be more constructive going forward. The bad news is this is designed to keep the U.S. with leverage, even if we renew USMCA, because we have these other issues that we could use to impose tariffs on Canada.
Now, these tariffs aren't in place just yet. Experts say important to point out there is a process. The USTR will hold hearings about them July 7th. Abigail Beeman, CTV News, Washington.
Coming up, prices at the pumps continue to be a point of contention for many Canadians as warmer weather is now settling in. We'll break down the latest numbers after this. Stay with us. Shares of Canaccord Genuity are surging today. That's after the company posted higher than expected fourth quarter revenue, with that metric jumping 33% compared to the same period the year before. Profit also came in above expectations. Canaccord says the results were driven by higher investment banking, while wealth management continued to scale. And shares of Broadcom are taking a hit in today's trading after the company delivered a disappointing forecast for sales of its AI chips. Analysts are also noting that AI sales and margins for the current quarter came in weaker than expected. On the upside, though, Broadcom posted profit and revenue in its latest quarter that actually beat estimates. And shares of CrowdStrike are in the red today. The security software firm reported profit and revenue in its latest quarter that beat consensus, but investors are focusing on its sales outlook for the second quarter. That forecast failed to impress. Analysts also note billings and net new growth were slightly below previous quarters. And we're keeping an eye on North American markets today. The TSX seeing some gains, up almost a full percentage point now. S&P 500 has flipped into the green ever so slightly, but the NASDAQ is still down to start the day. We'll continue to watch that for you. Also watching gas prices, which remain in focus for Canadians as warmer weather sets in. Cities along both coasts are continuing to see the highest average costs. So for more, we are now joined by CTV's Kamal Karamali to break it down. Kamal, good morning. Good to see you. So Canadians coast to coast, they're continuing to deal with these really fluctuating gas prices. Break down these numbers for us in terms of who's seeing what and where.
Hey, Lindsay, good to see you too. Not good to see the prices at the pump this morning. There's going to be a little bit of sticker shock as drivers got pretty used to the lower prices that we were seeing earlier this week, but it's shot right back up 7 cents to 10 cents in many parts of the country. And that was the lower price. Optimism that the end to the, or at least this, the end to this iteration of the U.S.-Iran war was just around the corner. But now we haven't seen anything concrete in terms of a peace deal. So things have gone back up in terms of prices at the pump. The national average about 181 cents per liter. What you're seeing on your screen here are some of the highest prices across Canada. We're seeing them go up above $2 in parts of the country. Vancouver was just $2.02 Tuesday, now up to $2.09. St. John's also shot up about 10 cents in the past couple of days. And Toronto and Ontario jumping up about 8 cents. It's about $1.77 today on average. The lowest across the country, we're going to continue to see that happen in Alberta, where we usually see prices a bit lower, but it's still higher than what we saw a couple of days ago. As you can see on your screen here, we're seeing a few cents increase there. So some not good news as it is expected to stay stable, Lindsay, for the next couple of days, but not even close to what we were seeing a couple of days ago in terms of the lower than usual prices.
Yeah, and there were reports earlier this week that the U.S. could be close to reaching a deal with Iran to reopen the Strait of Hormuz. I know we've heard that before, but potentially this time, if that were to actually happen, like how soon could their progress on an MOU actually impact gas prices here at home?
Yeah, and that's part of the up and down that we're seeing, right? We're hearing the U.S. and Trump say that they're reaching or inching towards a peace deal, but Iran is kind of singing a different tune. So really that is sending the markets in a bit of a tizzy and confusing a lot of people in terms of what they should price oil and other resources as well. So we know that crude oil inventories are in a free fall. We're seeing a drop in about 8 million barrels in the last week of May, and overall roughly 64 million barrel drop in total since the beginning of the Iran-U.S. conflict. So U.S. inventories have been drawing down for about 7 straight weeks. So even seeing a potential turnaround, we wouldn't see that for anywhere from 3 to 6 months, even if a peace deal happened today, because they have to restock a lot of those inventories. They're in kind of sifting through and really digging deep into those inventories. So even kind of refilling them back up, Lindsay, and then transporting the oil to those global markets is going to take months. And so we're nowhere close to seeing these gas prices go back down. Ideally, maybe in the fall or end of the year, but that is even if a peace deal happens today.
Yeah, it's quite the trickle-down effect. Okay, CTV's Kamal Karamali joining us live. Kamal, thanks so much.
Anytime, Lindsay.
Okay, it's time now for the ETF report. A blockbuster earnings season has pushed markets to an all-time high, but are profits sustainable? And where can you find opportunities? Let's unpack with Jay Hatfield, CEO and Portfolio Manager of Infrastructure Capital Advisors. Good morning. Thanks for joining us.
Good morning, Lindsay. Great to be on.
So let's start with the broader markets. It's been a blockbuster earnings season. It's been pushing markets to an all-time high, but you say this is an earnings bubble, not a price bubble. Explain that, and is that sustainable in the long run?
Well, we started the year with an 8,000 target on the S&P, and that represented 23 times 27 earnings. Well, remarkably, those estimates have risen just in the first half of the year over 12%. So our upside target, which assumes the straight close reopens rather, which is problematic, as you already referenced, we'd have a 9,000 target. But even our downside target with the straight remaining closed for the rest of the year would be 8,200. So unlike the dot-com boom, where we were counting eyeballs and almost every IPO had no earnings, this is an earnings boom. So it's not a bubble. And that's really why you've seen an unbelievably stable market in the face of really terrible headlines about oil prices and straight. Even today, where Broadcom's blowing up, CrowdStrike's blowing up, well, we're just rotating to the non-tech stocks. So you have to pay attention. Normally, stocks are super weak in June. They just won't go down. So that supports our 8,200 to 9,000 target on the S&P, depending on what happens with oil prices. And importantly, the real linkage is oil prices drive interest rates, and that supports a higher multiple, like 23 times.
Okay, I want to get to some of your stock picks. There's a couple to go through and then an ETF as well. So we'll start with Oracle. Tell us where are you seeing opportunities with Oracle?
Well, we like Oracle because it's well hated by most. The bear thesis was that they're spending way too much money. They're not going to get any return on investment. Their CDS is blowing out. But our models show that the credit's going to improve significantly next year. They're going to have pretty modest capital requirements. And they're not making these investments without getting a great return on them. This is their cloud business. And they do have a software business, so hedge funds like to short a one-off application. This is mission-critical database software with AI embedded into it. So we think that the software business is going to be beneficial. We have a 350 target on it, and so we like it. They're reporting next week. That's always problematic, but we think that the hedge funds have overdone this short software trade, particularly with the cloud service providers who happen to have software businesses like Microsoft and Oracle.
Amazon is another one. You say the stock performing well regardless of how the straight negotiation plays out. Tell us more.
Well, what's great about that stock, it's not a super high beta stock, or in other words, has less market risk. So even if we did get a pullback in the market, which, like I said before, doesn't seem like we're going to, but you've got the defensive retail business, it's becoming more profitable, and then the booming cloud service business. And we always like to pick on Walmart a little bit, whereby they're trading at a 4 peg, so they grow at 10 and trading over 40. Amazon's trading over 30, growing at least 20%. So much better peg ratios, and that's what we use for our valuation. It's a truncated DCF, and everyone really should look at discounted cash flow when you're investing.
You're also liking at the moment Lockheed Martin. Tell us more about why you like Lockheed Martin.
Well, the great thing about that stock is, if we're wrong about the market, it's literally defensive, but it's also defensive in terms of the market as a whole. It has a remarkably low beta, so sensitivity to the market of 0.2. And that's a great that you're putting that chart up, because really for no reason it plunged down to 500. Our explanation is when semiconductor stocks are going up 10% a day, why do you need to be in boring 0.2 beta industrials like Lockheed? Yet whether the war continues or stops, they're going to have to, or the U.S. is going to have to restock all of its missiles, talking about increasing defense spending dramatically. The CEO said this is one of the best times ever for defense companies. So just a super low risk way to get a company that's discounted for really no reason other than just market flows between super high beta stocks and out of defensive stocks. I wanted
to also ask you about the new ETF you just launched. It's called QVOL ETF. It screens the NASDAQ, deliberately leaving out some big names on the NASDAQ. Tell us more about the strategy here.
Well, you know why we're excited about that? We call it double curation. Most investors, much less average people, don't realize that there's a tremendous amount of dogs. We call it dogs of the DAC, dogs of the NASDAQ. So you think you're getting the most innovative companies at least in the US, if not the world, but that's not what you're getting. You're getting the 100 largest companies. So you're getting Walmart, getting Costco. Those are in our models, overvalued companies. You're getting Kraft Heinz, Mondelez. So most tech growth investors don't want those companies, and they happen to be overvalued. So we take those out. We have 55 of the best companies, and we write calls to generate income. But the same thing, we do it on the stocks that are fully valued. We have an equal weight position in Broadcom. So that would be a great candidate to write calls on. It's going to be out of favor for a while. It's undervalued in our models. So pick the companies to write calls on as well. First of all, pick the best companies, and then among those companies, pick the ones that have run up a lot, like Marvell. So use human intelligence to curate the options as well as the companies. Most of the competing funds are effectively index funds. They have all the companies, including, cable companies that are getting disadvantaged. So double curation, we think that we'll be able to actually beat the NASDAQ, not just these dysfunctional index call writing funds.
Okay, we'll have to leave it there. Jay Hatfield, CEO and Portfolio Manager of Infrastructure Capital Advisors. Appreciate you joining us. Thank you.
Thanks, Lindsay.
Coming up next is Hot Picks. We will zero in on the biotech sector right after this. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the biotech sector. Let's welcome Jeff Meacham, Global Head of Healthcare at Citi, to talk about this. Great to have you join us. Good morning.
Hey, Lindsay. Good morning. Good to talk to you.
Yeah, before we get to your Hot Picks, I just want to talk about the biotech sector in general, because it's been a couple of difficult years for biotech stocks. So I'm wondering, are you starting to see the beginning of a sustained recovery in that area?
I think we are. The capital markets has definitely improved this year, really over the past, let's call it, 9 months or so. Lower interest rates, maybe a little bit more. And I agree with you. I mean, it's a couple of years of a bit of a nuclear winter, and we thawed out of that last fall, and I think we're on an upward trajectory looking to end of this year and even into next.
What's driving investors back into the biotech sector? Like, what's exciting them?
There's a lot of really cool technologies. If you look at the last funding cycle in the 2020s, it was mostly preclinical, early stage platform companies. And now the same platform companies have real drugs in clinical trials, right? And have meaningfully good data that looks different. So it's just the typical innovation that you get in biotech, but with a little bit more mature companies.
All right. Your first hot pick today is Eli Lilly. Tell us more about what opportunities you're seeing here.
Yep. Yeah, so it's been our favorite stock for quite a while. We just got back from a site visit to their offices in Indianapolis. Very, very exciting, pipeline, portfolio, et cetera. I think the first thing I would say is that there are a lot of companies, Pfizer and Amgen and others that are heavily investing in the metabolic disease, obesity, diabetes space. But Lilly has, I think, probably the best suite of products today in the market. They're launching an oral called Foundayo. They have a couple of newer assets that are in clinical trials, but they're also moving the ball into related diseases outside of diabetes, obesity. This GLP-1 mechanism can be used, for example, in inflammation and neuropsych, and even in oncology. So the totality of the applicability of these drugs is, I think, far wider than people really realize in our view.
Veradermics is the next one. You say there's positive on the commercial opportunity for male and female pattern hair loss. Tell us more about what Veradermics is working on.
Yep. So Veradermics just IPO'd this year. They have a successful phase 3 in male patterned hair loss. One phase 3, have another to come at the end of the year. And the untapped market opportunity, not in really anyone's models, is a female population. That's still a trial that's ongoing right now, but the mechanism should work in the female population for sure. And then when you look at the outside the U.S., there's really nothing in people's models for anything, beyond the U.S. And so there's a lot more to come. Despite the stock doing quite well, there's still a lot ahead of it, in our view, based on clinical data and obviously commercial.
What risks are facing this company?
If you look at the regulatory, I think it's pretty straightforward. There hasn't been anything on clinical trials that's looked untoward on the safety profile, but that's why you do the experiment. That's why you still have to do the the large scale human studies, and so that's probably one of the bigger ones is maybe something that's unforeseen in clinical development. I think that's a low probability, but you never say never.
Okay, you've also got Amylyx Pharmaceuticals as one of your picks today. You say it's also working on some high unmet needs. Tell us more about that.
Yep. Yeah, this is one that's a orphan disease company. So in patients that get bariatric surgery, either previously or going forward, there are a little bit less than 10% of patients that have uncontrolled hypoglycemia. So Amylyx is working on a drug to address that. And it's really a kind of a brutal indication where, the adverse events, the side effects, can be often fatal. But this is, again, a rare disease with Amylyx working on a phase 3 trial. We'll have data sometime next quarter on it. It's called avexitide. And that's you can get orphan drug pricing. It's a massive unmet need, and there are really no companies entering this space.
And again, any risks associated with Amylyx Pharmaceuticals?
Yeah, the main one is just the same as Veridermix, really just clinical trial risk, right? What you get in mid-cap biotech is, you get a massive value inflection point if the trial is successful, but you also have, the unforeseen, whatever happens on the safety tolerability side, or if you didn't meet investor expectations on efficacy, that's probably the biggest risk to drive volatility in these stocks.
And same question for Eli Lilly. I realized I didn't ask you about risks for that company. You say the second two have similar risks. Eli Lilly is such a big company. Yeah. What about Eli Lilly?
When you think about Lilly, I think mostly just given, it's over $1 trillion cap, highly profitable, probably the biggest company in healthcare on the planet, but just meeting investor expectation each and every quarter is probably one of the bigger risks that drives, volatility in the stock. When you think about, the pipeline, the current trends for commercial, they're all kind of up and to the right. They're all progressing, but you have to beat numbers each quarter, and so that's kind of where investors hold their feet to the fire.
I wonder too, as we're starting to see more momentum in the biotech sector, is it getting easier for biotech firms to raise more capital today than it was a couple of years ago to invest in some of these projects?
For sure it is. I would say, both in the venture and the IPO market, definitely heating up today. I would say that some of the projects today, maybe they're aided by AI, maybe their probability of success is high. We won't know that answer really for the next couple of years. You still have to do the experiment of a clinical trial. But in general, though, I would agree. I mean, the investor appetite, after a couple of years of kind of minimal activity, the enthusiasm is back.
Okay, we'll leave it there. Jeff Meacham, Global Head of Healthcare at Citi. Appreciate your time. Thanks for joining us.
Thank you.
Up next is On the Radar with Grant White to see why Alphabet is on his radar. Stay with us. It's time now for On the Radar. To tell us why Alphabet is on his watch list, we sat down with Grant White of Endeavor Wealth Management.
Alphabet is such a great company, as a lot of people know, and I think what I really love about this in this point in time is that there is a little bit of price weakness, and that's a relative thing as it comes to Alphabet. I think you can get Alphabet at a pretty good price right now as compared to where they've historically traded, especially on a price earnings basis, and you can go into multiple factors there. But I think if you're looking at AI, the AI trade in particular, I really like a company that has multiple revenue lines going on, and certainly Alphabet is one of those companies. They are basically at the forefront of all of this technological innovation that's going on. I mean, not only on the AI side, but you've got self-driving cars, you've got cloud business, you've got search still. You've got so many good things going on with this company. So anytime you can get weakness on such a great company, I think it's worth the buy. So on top of that, I mean, if you look at their buyback, I mean, they don't pay much of a dividend. It's about 0.5% or so, but you get some buyback yield on them. And so just holding Amazon, you're getting about 3.5% to 4%, which is pretty nice in a company like them. And they're still growing at 20+% per year. So
And it's shown it can adapt too, right? It's a search engine.
Yeah.
And then all of a sudden you look and it's like, poof.
One of the most innovative companies ever to have existed, frankly. I mean, I kind of look at them as a modern day Berkshire Hathaway a little bit because they've got so many different good things going on. It's a nice conglomerate of that. So I would argue it's a pretty safe way to play the AI evolution that's going on here because they're going to participate in it. But they've also got, stakes in SpaceX, for example, as SpaceX is about to go public. I think they still own about 8% of that company. So they've got a really nice portfolio of businesses there.
Any worry it's spread too thin?
No, I think they are so well managed. I mean, again, some of the top managers in the world are working at Alphabet, so I'm not worried about them being too thin. The only thing I might have a bit of concern about, they are spending a pile of money on AI, and the question can be around what's the ROI going to be on that $190 billion or whatever they're committing to spending right now. But overall, I think if you think AI is going to be a thing, and I do, I think they're going to be just fine in that.
It really does feel like AI is starting to build into the fabric now, doesn't it?
Yeah.
Of society. Like it's becoming something that's just there now.
When we stop talking about it, then we'll know we're really there.
Yeah.
Because it literally is part of every single business right now to a certain degree. And I think that the companies that are embracing it more are going to do very, very well. And Google and Alphabet are going to be very happy to sell their services to you. So.
All right. Canadian company Alimentation Couche-Tard. Fun to say.
Yeah.
And just solid. That's one of the ones when it's part of the fabric, right?
Yeah, I think again, we talked about rotation from some of these chip companies perhaps into more of a core holding. Couche-Tard's one of those companies that is quite a bit of a core holding that you could feel comfortable with. I mean, it's one of those companies you can own for decades and probably do very well on it. They've gone through a lot in the last few years. I mean, the 7 and I pitch to try to take over 7-Elevens and so on. And that didn't work in their favor, obviously. But, I think that's...
But that wasn't necessarily a bad thing, though, was it?
No, I don't think so at all, actually. I mean, that was a big pill to swallow for them. And so there was a lot of concern out there that actually might not have been a great thing for them to do. But that being said, I mean, they've freed up a lot of bandwidth. They're certainly out there looking for other opportunities right now. And I think the question on them will be is, can they move the needle enough with some of the smaller acquisitions that they've been known to make, like the regional European acquisitions that they can do, and I'm sure they're looking at right now. Does that move the needle enough? I mean, I think there's still really good opportunities in places like Europe where you have these regional players where they can make those good acquisitions like they have in the past and do very well. But it wouldn't be the worst thing either if they looked at their free cash flow and said, hey, we're just going to keep buying back more shares. Yeah. And so as a shareholder, that's a really good thing for you as well. So I'm pretty optimistic about it. I mean, I think that you could be expecting, a 9 to 10 to 12% type of return annually over the next 5 years from Couche-Tard, and especially coming off the backs of what's going on over the last few years.
All right. And the last one, Cuba Libre. No, I'm just kidding. I was hoping it was Cuba Libre. Mercado Libre.
Mercado Libre. This is a company we've held for quite some time, a number of years now. And, I think actually, so a lot of people characterize this as the South American Amazon. I think that's a bit of a stretch because they don't have the cloud computing business and the AI business like Azure. What they do have, though, it's more of a combination of like a PayPal, Amazon. You could throw in Block in there. Where they're going to do really, really well, and they are doing really well, is on the payment systems, and they're getting into like microfinancing type of situations as well. And so that's starting to show up a lot more in the revenue lines and the profit lines. Again, it's a really fantastic business. You're getting great growth rates there. I mean, you're getting a price earnings at close to about 30 times, which seems really rich, but their growth rates are more than justifying that in my mind. And so, I mean, this could turn 12 to 18% annually over the next 5 years quite easily, depending on market conditions. But they're looking very, very strong and again, very well managed. So lots of great moats around it.
That was Grant White of Endeavor Wealth Management. Okay, we're going to take a quick look at the markets before we wrap up here. We're seeing a bit of a rotation today out of the chip makers and into a broader category of companies. The TSX is up, the S&P 500 also up, the NASDAQ down by 0.5%. And this comes after Broadcom reported some disappointing earnings. Of course, we've been telling you about that this morning. Strong earnings, but did not meet really high expectations. And so we're seeing the reflection of that on the NASDAQ. The TSX up, as I mentioned, driven most by the materials index. And we'll take a look at some of the companies on the TSX. Descartes Systems, a software company, top of the TSX today after Q1 earnings beat estimates. Descartes reporting higher profit and revenue. On the flip side, Celestica is sitting at the bottom of the TSX right now, potentially because of Broadcom and that sell-off that we're seeing. And then we're also watching TransAlta, which is falling after it agreed to buy Colorado's gas facilities, Mountain Peak Power and Canyon Peak Power from Blackstone. That total value of the transaction is $1 billion. Investors not too happy about that. That wraps up this edition of The Open. Morning Markets is up next with Roger Peterson.